Hello and greetings. This is the SEC Comment Letter Trends Among Life Sciences Companies webcast presented by the Life Sciences practice here at Moss Adams. Before we begin, I will be playing a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And with that, I'll be turning things over to our presenters for introductions.
Great, thank you, Gerald. My name is Stephen Fineberg. I'm a partner in Moss Adams in my 17th year here. Cover mostly internal controls work and SOX and internal audit. And I'm thrilled to be here to talk to you today about the SEC comment letter elements. Arlene?
Thank you, Steve. Hello, everyone. I'm really happy to be here. My name is Arlene Chan. I'm an audit partner located in the San Francisco Bay Area, where I primarily work with life science companies, both public, private, and so forth. So with that, I'm going to hand it over to Megan.
Hi all, I'm Megan Cappy. I'm a senior manager in our business risk services practice. I focus on SOX and internal audit, and I am located on the East Coast. So excited to be with everyone today.
So with that, I'm going to kick off our webcast today with a quick overall market and background context. So first of all, our comments today on the SEC comments relating to life science companies covers a period from May of 22 to April of 23. And so with that context, that's what we refer to as the 22 to 23 year. And so quick overall, the deal activity has dramatically decreased over the last 2 years. And this is probably not a surprise to anybody who is involved with the life sciences industry. The global IPO market also fell by 94% since 21. So the proceeds from the life sciences transactions have accordingly declined as well by over 50 billion because of the lack of IPOs, especially from 70 billion to about 20 billion. And this, of course, is amidst a different macroeconomic climate as compared to 2 years ago. So it's a very stark IPO market with no life sciences direct listings and a very small number of de-SPAC transactions. So some of the key industry trends within this market, there continues to be demand for R&D, lifeblood of life sciences. The FDA approved 37 novel drugs in 22, but that is a downward trend, declining from 50 drugs approved in 21. We all see that the COVID-19 pandemic frenzy has somewhat faded, fast cures have somewhat subsided. So the emphasis is on concrete and long-term systematic clinical trials and those results of R&D efforts. So what we're seeing in the market also as a result of the capital intensive nature of the life sciences industry, there are new financing mechanisms, whether it's increase in funding from the private fundraising sector, different and innovative forms of debt financing, and life sciences companies implementing operational cost cuts, making sure that you're more frugal in their research and development approach to extend the runway of their cash. And this is all in a background of rising interest rates, inflationary pressures, financial market instability, together with a strong US dollar and a relatively weaker global currencies. These all impact life sciences companies' financial strategies, financial performance, leading to operational decisions about their R&D efforts. So this has also led to more focused efforts for strategic alliances and collaborations to share costs. That being said, investors are optimistic that there are better days ahead with a recovery in the IPO market and momentum expected to gradually pick up in 2024 going into 2025. While a 2021-like boom is probably unlikely, a growth in deal size and deal count is expected. So what does this mean for companies, both private and public? This is a great time to take advantage to reinforce relationships, whether it's with internally within your companies, as well as with external relationships with bankers, attorneys, your accountants, to lay the groundwork for a focus area of efforts with respect to whether you're preparing for an S1, for an IPO, to lay that groundwork, or to continue to improve your disclosures in your SEC filings, which now leads us to the overall trends in the SEC filings and the comments that we have seen over this past year. There were, and let me forward to the next slide here. Here we go. So there were about 693 total comments. And this is over Form S1, 10K, 10Q, and 20Fs. However, compared to the prior year, this is a large decline in total overall comments. There were 1,625 comments in the previous year. So key areas for the SEC comments relate to R&D, SEC reporting, which really is compliance with requirements, and also providing clarity and disclosures over entity background and MD&A. And so with that, I will just say we are very happy to be here to share with you our look back at the SEC comments in this period to help gain insights. And before we get into greater detail, I would like to advance us to the first polling question. Gerald?
Thank you, Arlene. So on screen is the first polling question. Please remember this is a two-step action to put in your reply. You'll want to click directly on your answer choice on the slide, And then secondly, hit the submit button after that pops up on your screen. We'll give everyone a few seconds here to enter their replies.
And I will read the question. Are you aware of whether your company has received an SEC comment letter in the last 3 years? This is great.
All right, we'll
We're
give
getting
everyone
78.
a couple more seconds.
Yep. We're over 80%.
And let's look at the results. Back to you, Arlene.
Thank you, Gerald. So it looks like a majority of folks are either not aware or have not actually received an SEC comment letter. Over the last few years, the SEC has stated that they expect to review or attempt to review every single public company's filings at least once over a 3-year period. So if you have not received anything in the last 3 years, just be aware that the SEC has that intention. And with that, I'm going to hand it over to Steve Fineberg.
Great. Thank you very much, Arlene. So we'll break this out, the last sections, into two pots here based on the previous slide we'll look at the Form S1 filings and the comments associated with that. And then I'll hand it off to Megan, who will take us through the annual filings. Per the comments of Arlene, you can see, and this would be fully expected, that within the S1 comments that the number one area that you would expect from a topic would be research and development. But the S1 filing claimed more SEC attention than other filing types. It's usually the S1 that gets more comments. And to Arlene's comment about fewer comments overall, it was because there were fewer S1s overall, which led to fewer comments. So again, the Form S1 filings claim more attention than any other filing types, making up 70% or 487 of the total comments, down from the prior year where it made up 92%. This is 70%. You'll notice that there's these buckets and they sort of stop with 2%. At the bottom is this 19% other comments. Those are basically comments that are less than 2%. It's more of the potpourri bucket, where it touches on topics like emerging growth companies, controls and procedures, proxy disclosures, language-related matters, but we're not a prominent part of any other particular bucket. So as you can see here, I mean, welcome to the public company party. Then here's some comments for you. So definitely the S1 is where they happen. Just as one more note, I just want to remind everyone that this is based on middle market companies. And so we looked at companies with a market cap of less than 2 billion primarily. And so those are the S1s that we're looking at here primarily. So within that big bucket of 17% R&D, let's dig into that a little bit. So as Arlene indicated, R&D is at the heart of the life science industry. It leads the innovation and diverse product delivery year over year. R&D makes up the majority of the industry value chain from both a time and a cost perspective, and it stands at the cusp of what defines competitive advantage. And because these issues are critical, R&D did prompt the greatest number of S1 comments in the period. Again, there was 17% on the previous slide, and you can see here that they break down the sub-buckets accordingly. R&D is the most prominent category for the SEC review every period. Given the current scenario with the subdued market confidence and some unfavorable valuations, it's become imperative for companies to be objective with their R&D plans and keeping plans on issues such as feasibility, marketability, and development timelines pretty crystal clear. Pipelines need to be realistic and not overly ambitious, while clinical trials should be objective enough to give a transparent picture. As we talk about these buckets of the product pipeline and the product services, Item 101 of Regulation SK specifically requires registrants to describe their general business development and plans of operations. So this includes, among other items to include, is an explanation of material product R&D to be performed during the period. And like the previous period, the topic of clinical trials covered the most prominent subcategory of clinical trials and studies at 40%. Given the nature of this topic, the SEC placed most of its focus on requiring registrants to provide complete disclosure for all their clinical and preclinical studies. So this was include details of the studies such as Overall, the description of the design, the trial dates, who's the sponsor, the location, the scope and size, the duration of the study, participant characteristics, endpoints, and final results. Companies were also asked to disclose the statistical significance of clinical trials and explain how their p-values are calculated. So again, within that R&D, clearly the biggest bucket within there is the 40% clinical trials and studies. But as we get to later, we'll talk a little bit more about these products and pipelines to define the context of an entity as far as the documents are concerned. The next big bucket are entity-related information. A recurring theme throughout this report is that context is the most important thing, and context matters. Making comprehensive disclosures on the business background and operations is necessary for every company, especially those going public for the first time. So investors need to understand the contextual picture behind procedural disclosures and have a thorough understanding of what the company does, its business model, and where is its industry matrix. There were an aggregate 43 comments pertaining to entity-related disclosures this period, making up about 9% of the total S1 comments, down about 5% from the prior year. The scope of disclosure for entity background largely revolves around key parameters year over year, such as what is the entity's main business and objective? What is the business model and its revenue streams? How is it positioned in the external environment, including its competitive landscape, market potential, and size? Overview of the existing products and services portfolio should include rough segmentation and revenue breakdown, and collaborative arrangements that they're involved in, including ones that detail key intellectual property rights, should be described in detail. Included also would be the regulatory scope, the organizational structure, etc. Another key element of describing the products and services here in this entity-related information is the background of related persons, promoters, and certain promoted, certain control persons. Despite the decline overall in this category compared to last year, the category remained a significant part of SEC examinations and included new areas of focus. For example, while comments related to current products and services continue to claim much of the attention, those related to regulations and legal structure saw a much greater proportional share in the prior year, and this was followed by market-related comments as in prior years. All right. Risk disclosures. You can see here that there's the largest bucket here is the risk factors of 2/3, followed by updated disclosures. So the SEC scrutiny related to risk-based disclosures is consistently rigorous every year. In this period, there were 41 total comments, or 8% of the total S1, up from a share of 6.5% in the prior year. You know, risk is an inherent part of the life science business ecosystem, with each industry subset sector facing its own set of challenges and uncertainty. In the fast-paced life science industry, issues such as the need for constant innovation, technological advancement, product approvals, and then factoring in obsolescence, discovery, and intellectual property, also regulations, all of these stand at the forefront, and players grapple with achieving breakthrough solutions and getting products on the market on time and ahead of the competition. Therefore, the exact degree of risk can be varied based on the sub-industry sector, as well as a company's own dynamic operational dynamics. The management structure, the manufacturing capabilities, the compliance metrics, all of these are factors that go into the risk disclosures and risk disclosures factors. Unexpected events can create havoc in the sector, and being able to anticipate, identify, measure, and mitigate these risks issues is a priority, especially when companies are going public for the first time, hence the excessive pressure and focus on the S1s. Examples of risk disclosures are driven by, number one, product development. How's your performance in your clinical trials, your clinical holds? Are there safety concerns? Is there data validity, FDA approval, and other areas of risk? What about the regulatory backdrop? It can be related to product development or even operations at large, such as cross-border implications or working in countries with vulnerable and tight regulatory controls. Other risks include possible potential substitutes and price wars from competitors, debt and valuation issues if there's the chances of default or financial pressures, debt serving obligations, and possible asset cuts. Other areas include intellectual property rights, ownership variability and licensing dependency and restrictions, and march-in rights. All of these are key factors. Additional risk factors include management control if there's dilutive effects or concentrations of ownership or voting power. Also, process orientation, your internal and digital rights controls. Weaknesses in internal control over financial reporting are also a risk factor that should be disclosed. Also, material dependency. If you're particularly reliant on certain suppliers, customers, distributors, or stakeholders, that should be disclosed very clearly and in context. Also, legal disruptions. Those could be due to geographical spread or the control of operations. Another area might be share price volatility based on factors unrelated to the company performance or on market speculation. So the SEC continued to emphasize the compliance with the amended Regulation SK Item 105. Registrants were encouraged to discuss specific significant risks as opposed to generic risks affecting their business. But at the same time, to keep those specific and significant risk disclosures precise and concise. Meanwhile, some companies were asked to not only revise their risk factors for updates, but to also account for any recent transactions and reporting and resulting in new information. So updated disclosure is, again, another area of risk disclosure. But presentation and discussion are the key takeaways of this discussion section. The identification of all material risks as well as how well they're presented and discussed in detail are pivotal for managing SEC scrutiny. The next area of interest and focus is management's discussion and analysis. Again, this is management providing more context over their operations. MD&A is an important part of public filings and is required by Item 303 of Regulation SK. Companies must discuss their financial condition and changes to their financial condition in relation to the following key parameters as listed here: critical accounting policies, liquidity and capital resources, and results from operations. Comments related to MD&A made up 7.4% of the total S1 comments last year, a slight increase from 6% the prior year. Note that companies can supplement this MD&A disclosure with other information or parameters they believe are material to the understanding of the financial condition and operational results, especially if it provides greater context. The key is to present a complete contextual picture behind financial statements, narrating the story behind those numbers and signaling how they can change over time. Regulation SK Item 303 required disclosures includes descriptions and amounts of matters that have had a material impact on operations, as well as matters that are reasonably likely, based on management's assessment, to have a material impact on future operations. These basic parameters help companies present a transparent picture to investors about ongoing operations and frame discussions of their projections and expectations of the future. The objective is to simplify disclosure requirements to eliminate repetitive and unnecessary disclosures, as well as to allow companies to decide what information is specifically material to them and how to best disclose it. Within this category, there's these subcategories, which I'll touch on now. In alignment with Regulation SK Item 303, the SEC asks registrants to discuss and analyze material cash requirements for known contractual and other obligations, and to specify obligation type and the relevant time period for each related cash requirement. So this would include discussing any material changes in cash and cash equivalents reported in the financial statements. However, the greatest increase in comments in this period was attributable to registrants' offerings themselves, which had the SEC issuing comments of a similar nature across registration statements. When a company or where a company sees the likelihood of receiving limited proceeds in its offering from the exercise of stock warrants or stock options due to exercise and trading price disparity, it must expand its capital resources discussion to discuss any changes in its liquidity position, including the need to seek additional capital. In addition to this, companies need to express going concern opinions issued by their auditors, if applicable, in their liquidity sections, as well as any other factors or new developments that can affect cash directly and indirectly. The impact of recent and ongoing business combinations is critical here as well. Another big bucket of discussion in the management's discussion analysis is the critical accounting policies. Comments directed towards these critical accounting policies made up almost 30% of the MD&A mix in this year, which was substantially down from the prior year of 66%. This category has historically attracted most of the SEC's scrutiny in MD&A for years. So it's good to see that bucket a little bit smaller. Nature of comments was largely the same, however. The SEC placed emphasis on registrants to outline their method, assumptions, and estimates underlying critical accounting measurements and how changing them would impact financial results. This includes providing accounting treatment for material collaborations and contractual arrangements, debt and equity instruments, share exchange transactions like asset acquisitions and business combinations, treasury stock transactions, arm's length basis for intercompany transactions, or determining depreciation, amortization, and net realizable value of inventory. For IPO registrants, as in prior periods, there was also comments pertaining to stock value, as registrants were just asked to disclose the differences between the fair value of the common stock leading up to the IPO versus the estimated offering price to clarify their accounting for equity issuances, cheap stock, and stock-based comp. Comments related to operational results or results from operations made up about 20% of the MD&A comments this period, a slight decline from 22.5% in the prior year. Like previous years, the SEC requested registrants to provide a more detailed analysis for each material quantitative change in operating measures from period to period, which included identifying and possibly quantifying all company-driven factors and market forces causing those changes. Some filers were also asked to update their business operations and financial position to account for the completion of any recent transactions and business combinations, as mentioned. This category's takeaway is clear. Companies must present their operational performance in numbers and supplement this information with unambiguous and holistic and narrative disclosure in a way that's transparent to investors. MD&A, gotta love it. And then so here is, I believe, another polling question. So, polling question here is, what is your current filing history? And this is just a make sure you're paying attention question here. What is your current filing history? A, we are a pre-public company. B, we've filed an S1. Or C, not only that, but we've also filed a 10K. Or D, we're in another bucket altogether. Perhaps we are a D-SPAC, a direct listing, which again would have been S1, or an S4. So with that, waiting on a few more people to submit their responses here for the polling question. Again, what is your current filing history? We'll wait just another moment. We got about 80% of folks for the polling question. So,
yes, and before we advance to the results, Steve, just a reminder for the audience, if you have any questions about the content itself, there is a Q&A tool in your user console that I am now highlighting, and you can enter in your questions at any time. With that, let's look at the results. Back to you, Steve.
Great. Thank you, Gerald. So you can see here, a lot of folks are public. They've filed a 10K. And there's a bucket here of other, so it'll be interesting to figure that one out as well. So just as a side note, I've been mentioning the change in comments in terms of number year over year. A change in comments for a particular category really shouldn't be construed as a reflection of its importance. Really, a declining number of comments could suggest companies are successful in their efforts to continually make disclosure improvements, thus avoiding future scrutiny. But also, as I mentioned, there's fewer S1s that were filed in the current year, and so there's just fewer comments overall as well. But anyway, just as a sidebar. All right, moving on. We're still in the S1 bucket here. So one of the areas of comment was IPO-related disclosures. And you could see them split between about 2/3 on the offering versus 1/3 on the use of proceeds. So comments related to the actual offering made up about 2/3 of the IPO-related category disclosures this period, which is up from about 43% in the prior year. Focus on IPO-related disclosures constituted about 10% of the total Form S-1 comments in the period, if you recall from the one of the initial slides. As in the past, these comments are procedural in nature. The SEC either required registrants to make specific disclosures related to the actual offering or clarify the use of proceeds. These requirements mainly stem from Regulation SK Items 501 and 504, as well as compliance with rules and regulations under the Securities Act of 1933. The goal is to help investors gain clarity on all offering terms and conditions and understand how registrants wish to use the proceeds. On a generic level, IPO applicants need to make sure that they have disclosures on the offering type and price, the description of the securities, the structure, the underlying conditions, the overall eligibility, and then the use of the proceeds with breakdown and commentary on that. Like prior periods, most of these comments came from the cover page, where the SEC required many registrants to clarify common features for their offerings, such as the number and type of securities being registered, the price of the securities, the termination date, and any arrangements in place that fund in an escrow, trust, or other account. Concrete disclosure became even more critical during certain types of offerings. For example, in cases where the offering was being conducted at an assumed or assumed combined purchase price, the SEC requested companies to state the price of the securities to the public and then clarify whether that price will be fixed. If no price can be stated, then the filer must disclose the method by which the price will be determined. Similarly, these registering multiple securities, such as shares and warrants, must clearly state the shares of common stock issuable upon the exercise of such warrants. This provides a comprehensive picture of all securities that are part of the registration statement's offering table. If the offering is contingent upon securing listing approval in a market, then it must be stated clearly in the beginning of the statement. Apart from these above common factors, using objective disclosure and language when discussing the type of offering being registered is crucial. The SEC has issued several comments this period asking registrants to distinctly describe their firm commitment or best efforts offerings and outline what they entail. On a holistic level, clarity, consistency, and comprehensiveness remain crucial. IPO applicants should spend adequate time covering the required elements for the entire filing document, including the outside and inside cover pages. For use of proceeds, a clear plan for the allocation of funds is a pivotal part of every prospectus. It helps investors understand how registrants intend to use the funds raised to further their business objectives. Consequently, the SEC's scrutiny over the use of proceeds pursuant to Regulation SK Item 504 maintains significant traction year over year. So comments pertaining to these disclosures made up about 33% of the total IPO comments, which is a significant dip from the prior year of about 56% of these IPO-related disclosures. Like prior years, the SEC required registrants to clearly outline how they would use these proceeds raised from the offering to meet their specified purposes and quantifying the breakdown for each purpose. They are also required to identify any other material funding needed, providing clarity as to whether the related sources and amounts come from. All right, moving right along. Resale offering. This one is, well, Form S-1 offerings aren't only limited to IPOs, and so companies can register stock for sale from various types of other transactions, including direct public offerings, resale or selling shareholder offerings, or private investment in public entities or PIPEs, or equity offerings. And so this period saw a sudden influx of comments pertaining to resale offerings, which for the first time made up about 11% of the S-1 comments. There were none such comments in prior years. This is a steep jump for just one period. And the scrutiny was very systematic, with the SEC issuing similar comments across companies, asking for each of the shares and warrants being registered for resale, a company should disclose the price that the selling security holders paid for such shares and warrants overlying the securities. Additionally, you should disclose the exercise prices of the warrants compared to the market price of the underlying security, including out-of-the-money implications. Additionally, outline differences in the current securities, trading price, and price sponsors or private investors paid in order to highlight the fact that public security holders may not experience the same rate of return. Apart from these concerns, a slew of comments followed suit, which, like those for the IPOs, required filers to provide more clarity on the securities being offered and all the offering terms. So again, clarity, consistency, comprehensiveness are also essential for disclosures surrounding resale offerings. And companies need to provide complete disclosure on not just offering itself, but also on the underlying implications, including its effect on share price, liquidity, and all other areas of operations. Okay, and now my last slide, we'll talk about SEC reporting. Within this, you can see there's various buckets. No matter how well a company meets or exceeds its performance targets and discloses them in the previous sections, it cannot succeed without keeping proper and comprehensive compliance checks in place, regardless of how simple or complex those compliance checks may be. So accordingly, SEC reporting or process compliance is a core topic that consistently makes up a sizable number of SEC comments every year. Meeting compliance requirements is a key parameter for every business in every industry, without which it wouldn't be able to function or meet its objectives. In the current year, comments related to process compliance made up about 11.5% of the total on that overarching slide. Like prior periods, registrants were asked to add or modify disclosures to align with Regulation SK and Regulation SX requirements to make their statements, again, transparent, comprehensive, and unambiguous. This included providing all relevant exhibits, updating financial statements, adding the right number of signatures, or preventing discrepancies or conflicting statements throughout the document. Even though comments in this section are generally formulaic in nature, they do make up a sizable volume every year, and companies shouldn't overlook the importance of process requirements, which can cause filing and transaction delays. So when we talk about discrepancies in a document as large as the registration statement, the risk of conflicting disclosures between sections is high. Registrants are required to provide similar types of information in a variety of different contexts, which, if not carefully checked, can lead to inconsistent facts, figures, or opinions throughout. Consequently, this topic brings up a fair amount of SEC scrutiny every year, and in this case, 11% were discrepancies. Another big bucket is the filing of exhibits and other material. Given the wealth of information contained within registration statements, a thorough index of material exhibits and reference documents is necessary. Comments in this subcategory comprise close to 34% of the process compliance mix this period, marking an increase of from 24% last year. Like the previous period, SEC scrutiny was standardized and procedural, requiring companies to comply with all exhibit guidelines as stipulated in Regulation SK Item 601, which lists all documents that need to be filed within a Form S1, plus those incorporated by reference. These include acquisition and reorganization plans, articles of incorporation, contractual arrangements, expert opinions, and consents, among other things. Companies were asked to file all relevant documents as exhibits and also file them in a searchable format, updated to reflect the latest versions. Another area, the biggest bucket, was these updated disclosures. Again, like the previous report, a considerable number of process compliance comments were directed at updated disclosures, a category which requires registrants to update information throughout the prospectus and clarify certain areas. As far as the other shareholders' equity is another bucket in that, the capital structure of the company and the nature and composition of shareholders' equity. Another area is licensing. Entering into license agreements continues to be a major strategy among life science players and helping them to reduce developmental costs, save time, risk, and synergies on expertise. Note that it's important on SEC reporting to document the nature, scope, and ownership of intellectual property, to define each party's rights and obligations, the duration of the collaboration agreement, the royalty term, the royalty range not exceeding 10 percentage points, and the types of payments involved, such as quantification of any upfront fees, aggregate payments paid, and any aggregate future amounts to be paid. So again, process reporting is key in SEC reporting. And this will lead us into our next polling question.
Thank you, Steve. This one reads, which topic in Life Sciences S1 filings receives the most SEC comments? The options are R&D, ICFR, internal controls over financial reporting, commercial research, or equity transactions. Again, select your answer here on the slide and then hit the submit button once it pops up on your screen. We'll give everyone a couple seconds here to enter in their answers. And as a reminder, if you have any questions, you can submit them into the Q&A tool that, again, I'll highlight on each of your consoles. Any questions that we receive that we don't get to on air, we'll be happy to reply to via email. All right, let's take a look at the results, and back to you.
Great. This should have been a sort of a gimme. Which topic in the Life Science S1 filings receives the most SEC comments? This is should be R&D, but of course all of these elements are listed in the reporting and are included as well. So, all right, and with that, I'll send it over to Megan to talk about the annual filings.
Wonderful. So overall, the comments that were directed towards our Form 10K, 10Q, and 20F filings, they did make up roughly 30% of the total comments, as you saw in a slide previously before. This is a large increase from the previous year, where roughly only 8% of total comments were directed towards these forms. As you can see on the figure on the slide, topics such as the MD&A, entity background, SEC reporting, and R&D were really the prime focus area of these forms for the comments. Unlike its Form S1 scrutiny, the SEC did focus on companies' operational activities, financing and operating results, and internal controls, along with requiring consistent disclosures across the filings. The Form 10K submissions attracted the greatest SEC scrutiny among the three filings. It had about 67% of the total comments. The Form 20F received roughly 27% of comments, and 10Q saw 6% of the comments. The distribution of the comments has changed over the years between the three forms. The skew in SEC comments towards the 10K has been easing, but attention to the Form 20F has been increasing. Fewer comments on a form could imply better compliance. With the Form 20Fs earning more comments, it's possible that the SEC is placing greater scrutiny on such filings, and foreign private issuers will need to pay greater attention to disclosures and matters of compliance. If we focus around management's discussion and analysis, those comments did drop by 11% from the prior year to the current year, but it still made up the largest number of comments for the period. The drop in comments related to the MD&A doesn't imply that there's less need for disclosure, but it could be the result of companies making improvements in their filings and disclosures. The MD&A comments were largely focused on critical accounting estimates and results from operations. The SEC told several of their filers their disclosures for critical accounting estimates were merely descriptions of how they were accounting for items in accordance with GAAP. And however, what's really needed is to provide investors with a complete understanding of how the critical estimates are derived, how the uncertainty associated with those estimates may impact their consolidated financial statements. A similar detailed reasoning was required for disclosures on operational results. The SEC required companies to engage in a detailed discussion for any material changes in operational results and present a quantified analysis of significant factors that led to changes. So the key takeaway here is identification, quantification, and discussion. Then moving into the entity-related information, the SEC focused on entity background has increased significantly for public filers over the last two periods. It grew 11.6% in that 2021 to 2022 period, and then it's actually up to 18.4% in this last period. Examinations were largely focused on the company's legal structures, including those subsidiaries, as well as the prevailing regulatory scope. Comments were targeted at companies having operations in foreign jurisdictions with a complex network of subsidiaries. This did include scrutiny of China-based companies. Over the last several years, the Division of Corporation Finance has issued specific guidance on disclosure obligations of companies based in or with a majority of their operations in the People's Republic of China. This covers a wide range of disclosures, including items such as variable interest entity structure, the reliability of financial reporting, the regulatory environment in China, and corporate governance matters. Further, the SEC has issued a sample letter to companies regarding China-specific disclosures, which is setting out requirements in those previously mentioned areas. Similar to S1, the SEC also scrutinized R&D for public filers, and R&D comments made up 10.7% of the total forms. This was an increase from 8.7% in the last period. As we've mentioned previously in this webcast and continue to mention, R&D is at the heart of the life sciences industry, so it should be no surprise that expenses are the focal point for the period. Nearly all of the SEC comments ask companies to be more proactive with the disclosure of their R&D expenses, focusing on that tracking, recording, monitoring, and reporting the expenses. In the event that a company would not track their R&D costs by product or project, they must disclose the information and explain it. Further, companies should be cautious when they're disaggregating their R&D expenses. The total cost if broken out must reconcile to that total R&D expense amount presented in the statement of operations. If there's been any material fluctuations in R&D expenses across different periods, companies will want to identify and discuss the specific factors that led to those changes. And a product or program specific breakdown is critical in helping the companies to identify that root cause for changes in expenses and your appropriate discussion. Moving into SEC reporting, comments related to process compliance did see a slight decline this period, constituted about 13.1% of the Form 10K, 10Q, and 20F, as opposed to that 14.5% share in 2021 to 2022. But similar to the prior period, most of those comments were directed towards certifications. For the 302 certifications, companies were required to revise them to include introductory language in that paragraph 4, referring to your internal control over financial reporting, as well as paragraph 4B, which is going to refer to the design of internal reporting. For the Section 906 certifications, companies were asked to refer to the correct fiscal year. Other comments that we saw requiring disclosure focused on that filing of requisite material, reconcile discrepancies in facts and figures, including the necessary audit reports that would address adjustments done to prior period financials, and ensuring compliance with sectional items. Procedural compliance is just as important for public filers as for those pre-IPO applicants. Companies must meet all of their sectional requirements for relevant forms and provide sufficient disclosures throughout. Other comments we saw were around risk disclosures, the nature of the SEC asked to disclose any significant legal, regulatory, liquidity, or liquidity enforcement and operational risks associated with being based or having most of your operations in China. So ultimately, the companies were asked to disclose any of that. They were really asked in focusing on risks arising from the changing legal system, risks arising from government control, thinking about if those risks could result in material change in operations or the value of the securities registered for sale, and how statements or actions by China's government on key matters may impact the company's ability to conduct business. Further, if we focus on internal control over financial reporting, it's a critical factor so that you're maintaining the credibility of financial statements and promoting information transparency. Like the previous study, the SEC did ask companies to make requisite disclosures when it comes to management's annual report on ICFR. This includes outlining the framework management used to evaluate the effectiveness of ICFR and providing a definitive conclusion as to its effectiveness. In the case of a material weakness or ineffectiveness of ICFR, companies were asked to clearly describe the steps that they took towards remediation and that status of those plans to enhance ICFR. The focus or scrutiny around revenue recognition was tied to the adoption of guidelines under ASC 606. For those not familiar with ASC 606, it's stating that an entity should recognize revenue when it's transferring those goods or services to a customer in an amount in which it expects to be entitled to receive from the customer. So filers are being asked to thoroughly review their customer contracts, especially those multiple element arrangements, and have disclosures that identify the promised goods or services under the agreement, explaining which promised goods and services are distinct performance obligations and which have been combined, quantifying that total transaction price and explaining how it's been determined, disclosing how the total transaction price is allocated amongst various performance obligations, as well as the amounts that have been recognized over the year. This would include establishing a point of control and when the goods or services have been satisfied or earned. So here with revenue recognition, clarity is essential for compliance. Companies are expected to have those clear-cut procedures for establishing completion of the performance obligations and recognition of revenue that's consistent with all types of contracts. Moving into our next slide, discussing market capitalization. So as mentioned before, the scope of the analysis did focus on smaller companies with market capitalization of less than $2 billion. With over 85% of those forums 10K, 10Q, and 20F comments centered on companies with a market cap of actually less than 500 million. So smaller companies continue to attract the greatest scrutiny. And similar to previous years, there's a negative correlation between company size and the extent of SEC scrutiny. The number of comments is decreasing as market capitalization is increasing. That negative correlation could be attributed to a difference in experience and resources. Registrants filing statements for the first time may not be as well versed in regulatory compliance and therefore attracting more SEC comments and requiring more iterations. Or smaller companies could have fewer resources to allocate towards compliance compared to larger companies, but those larger companies also may have more experience and in-house process for maintaining compliance. That current market capitalization distribution among life science companies does indicate that there may be a greater number of small-sized filers than large ones, which is also going to impact the distribution of the SEC comments to each category. But regardless of size, building that thorough understanding of the SEC's disclosure standards will help facilitate a smoother and timely filing process for all companies. This brings us to our final polling question. What is the route to successful SEC reporting? Is it A, familiarizing yourself with the purpose of SEC filing and taking note of designated forms? B, understanding your industry and requisite value chain of activities that need attention? C, identifying patterns in SEC comments, assessing those made for similar filings in the past? D, analyzing trends to understand features that must be accounted for? Or E, all of the above?
And we'll give everyone here in the audience a couple of moments to plug in their answers. Again, select your answer and then hit the submit button as a second step to record it. We'll give the audience here about 10 more seconds. All right, very good. So we'll go ahead and look at the results. Back to you, Megan.
So the results, it looks like everyone or most everyone addressed all of the above. That is the correct answer. So successful SEC reporting is inclusive of the 4 items listed, those A through D. Next, I will hand it over to Arlene, I believe.
Great. So this is a quick slide on sub-industry trends in terms of the amount of SEC review comments relating to each sub-industry group. I'm not going to go into detail here in the interest of time. We have 5 minutes left, but I will point you to where you can find the information. So in conclusion, we saw a continuation of the IPO dry spell in 22 through 23. The macroeconomic conditions also played a role. So it's crucial for companies on the IPO path within the IPO ecosystem to stay ahead of the filing process and structure offerings that capture investor interest. So maintaining sound regulatory compliance that can drive operational efficiency and reduce procedural delays. And this is equally applicable to companies on the path of an IPO seeking to become public, or for public companies in their filings. You can benefit from creating informative and sound documents, clear disclosures on critical matters, and this has the added benefit of investor confidence. Also, just a quick recap, popular topics are R&D, process compliance, entity-related disclosures, R&D research cost, developmental cycles, product pipeline, duration, and regulatory impact upon the research program. Disclosure in these areas is important. And so there may be new areas of focus that may emerge due to the changing market dynamics and legal mandates. As we've seen in this past year, the resale offerings popped up. SEC comments aren't limited to Form S-1 registrants, and so we hope this webcast has been informative and useful for everybody, including continuing SEC public registrants. So getting the process right the first time saves time and resources, and insights into these generic trends, coupled with guidance from specialist advisors, can help companies anticipate and avoid obstacles. So these comments today, and I want to thank Steve and Megan for joining me on this webcast. These comments are derived from our publication, and we hope this webcast was informative for you. You can access our publication on our website, which contains greater detail and also examples of the questions and SEC comments directly extracted from the SEC comment letters for each of the categories that we noted. So we invite you to contact us to discuss any questions and needs that you may have. But in the meanwhile, if there are any other questions, please feel free to indicate in the Q&A, and we'll give it maybe a minute more. But I do want to thank the audience for hanging out with us for an hour this morning, and best of luck in 2024, and thank you. I don't see any other. Yes, Gerald, I was going to say I don't see any other Q&A coming up, so I'm going to hand it back to Gerald to complete our webcast.
Yes. We'll be taking a look at any submissions that get sent in through the Q&A tool after the webcast, and we'll be reaching out if there are any submissions made after we close. Just a brief announcement for closing. In the post-event email that will be sent out from the webcast platform, attendees, all registrants here, will be receiving a copy of this presentation, as well as a link to view the recording of this session on demand in case you want to go back to a specific topic to rehear anything. With that, again, please visit us at mossadams.com and mossadams.com/lifesciences. We look forward to seeing you at a future event soon. Thank you, everyone, and have a great rest of your day.